Warren Buffett is probably one of the most famous and successful investors and one of the most experienced as well. The chairman and CEO of Berkshire Hathaway has been investing in stocks for several decades and his advice is timeless. The 90-year-old business tycoon has often shared his insights with fellow investors and the media, and by keeping his advice in mind, investors can try to avoid some of the common mistakes. So if you are thinking of investing in stock, then stay tuned till the end of the video as we take a look at 10 of Warren Buffett's investing tips for beginners. While investing in stock is not exactly easy, it is not as complicated as many people believe it to be. You don't need to be especially sophisticated to successfully pick the right stock, but there is no easy button either. No one can consistently beat the market, and there is no set of rules you can follow to make sure you always make the right investments. While following certain philosophies and tips based on the experience of others is certainly a start, investors need to keep in mind that there is no actual rules-based system to investing. Warren Buffett warns investors that if there was such a system, the inventor would certainly have no need for selling books or subscriptions explaining it. The business tycoon says investors should be skeptical of history-based models. Constructed by a nerdy-sounding priesthood, these models tend to look impressive. Too often, though, investors forget to examine the assumptions behind the models. Beware of geeks bearing formulas. His partner Charlie Munger agrees, adding that following certain principles when investing is fine, but it should never feel easy. He says, "It's not supposed to be easy. Anyone who finds it easy is stupid." The importance of having a diversified portfolio is often stressed by experienced investors, but Warren Buffett thinks it isn't always a good idea and says that diversification is usually for people who don't know much about investing. Buffett believes that experienced investors should rather go for stocks on a long-term basis and should have faith that their investment will pay off. Many investors choose to diversify their portfolios in order to avoid having one stock sink their entire portfolio. However, having investments in a lot of different companies also makes it a lot more difficult to keep track of the current events impacting each company. So, while diversifying technically reduces the volatility of your portfolio, it also reduces your focus on individual investments. Buffett thinks it makes more sense to wait for the right opportunity to buy good stocks, and he always takes full advantage whenever those opportunities present themselves. He says, "When it's raining gold, you put out the bucket, not the thimble." According to Warren Buffett, the best investment you can make is in your own abilities. Anything you can do to develop your own abilities or business is likely to be more productive. He thinks that it is better to invest in oneself because most people are more likely to make most of their money from their careers rather than their investments in stocks.
Well, by far the best investment you can make is in yourself. I mean, for example, communication skills. I tell the students that.
So it is a better decision to invest in your abilities before investing in stock. His partner Charlie Munger sees things similarly, and according to him, the secret to success is to sell yourself an hour each day and use that hour to make yourself better. This one is probably one of the hardest things to do, especially for beginners, but Warren Buffett says you should always trust yourself and your investment decisions. He says that you will always think you might be wrong and that others are right, but instead, you should make sure you do your research and then believe in yourself and your investments. The only way to become a successful investor is to overcome the fear and learn not to pay too much attention to what others are telling you. Instead, you should study and acquire the necessary knowledge that will allow you to make smart investment decisions and be a winner. On the way to becoming a successful investor, you will likely face some obstacles, and even though you should always believe in yourself, you need to keep in mind that we all make mistakes. Even an investor as experienced as Warren Buffett has made some mistakes in his career, and big ones too. However, the CEO of Berkshire Hathaway always makes sure that he learns something from his mistakes. He even advises investors, especially beginners, to keep a record of the mistakes they have made to be able to figure out what went wrong and avoid making the same mistake in the future. And Buffett also thinks that investors should share these mistakes with their children and even grandchildren so they can also learn from them and avoid them as well. One of the things you should keep in mind when buying stock of any company is that you are essentially buying a part of a business. So it's just as if you would invest in a store near your home, and you need to think about the store's competition, suppliers, prices, and so on. This means that you have to take into consideration the specific location as well as its competitive position in the market, and it is not at all that different when you buy stocks. According to Warren Buffett, if you want your investments to become successful, you should always think about all those things when buying stocks, because you need to keep in mind that buying stock means that you are not simply buying a piece of paper, but are actually purchasing an ownership stake in a business. While it is important to do some research before making an investment, Warren Buffett also says that you shouldn't think too much. According to the seasoned investor, you should never invest in a business that you don't fully understand, and if it is too complicated, it is better to move on to another company. He says that before investing in the stock of a company, he always makes sure that he fully understands how the company generates income and which main drivers impact its industry, and he tries to do so in no more than 10 minutes. Buffett says that if he doesn't understand it within those 10 minutes, he simply moves on to another company, evaluating it according to the same principle. No one can predict how successful a product or company will be in the future, and no one can predict the market with 100% accuracy, so in situations that would rely on an accurate forecast, you should avoid investing. Buffett advises to stay away from businesses that are too complex and simply keep looking until you find other businesses that are easier to understand and then invest in those. He also once said that out of about 10,000 plus publicly traded firms, he would only consider investing in a few hundred companies before even taking his valuation into account, so don't act hastily. While researching your investment options, you will come across uncountable news headlines, and Warren Buffett advises to try and choose the right news to focus on and not attach too much importance to every single headline you read. For this purpose, Buffett thinks it is smart to follow the 99-to-1 rule. He says that most investors act based on 1% of the financial news they consume and will often quickly sell their stocks whenever bad news comes up. Like when a company's revenues have fallen by 10%, for instance. However, if a company has been in business for a century, for example, Buffett says it is likely to have the capability of withstanding events such as the one described before. In other words, Buffett believes that people often tend to overreact because they attach too much value to every piece of news. Warren Buffett thinks the best way to ensure a good return on your investment is to buy a stock and then forget all about it, because he thinks it is best to hold on to stock for decades. He believes that if you don't believe a stock is worth owning for 10 years, then it is not even worth owning for 10 minutes. There are two principles behind this buy and hold philosophy. Firstly, if you buy a stock for less than its true worth, its price will eventually converge with its intrinsic value. And secondly, if you make a smart investment in a good business, the value of that business will compound and increase exponentially over time, meaning you will make more money out of the stock the longer you hold on to it. Buffett thinks the patient investor will ultimately be rewarded, while those who constantly buy and sell stocks will forfeit a significant percentage of their returns in the form of trading commissions and taxes. In other words, it is smarter and more profitable to buy great stocks and own them for a long time. As mentioned earlier, you should always understand the business you invest in and say no to complicated businesses and industries. You should still make sure you invest in high-quality businesses, and identifying those can be quite challenging. Warren Buffett has had more than 50 years of experience in investing, and his investment philosophy has evolved over those 5 decades. Nowadays, the billionaire investor focuses almost exclusively on buying high-quality companies with promising long-term opportunities for continued growth. Based on this, most people will be surprised to hear that the name Berkshire Hathaway actually comes from one of Buffett's worst investments. When Buffett bought the business, Berkshire was in the textile manufacturing industry, and he was enticed to buy simply because the price looked cheap. Back then, Buffett was convinced that if you got hold of a stock at a significantly low price, it will eventually pay off because there will usually be some good news sooner or later that will allow you to sell the stock at a decent profit, even if the long-term performance of the business remains terrible. Over the years, Buffett changed his philosophy, however, saying that this approach only makes sense if you are a liquidator. In the end, the original bargain price usually turns out not to be such a steal after all, since troubled businesses will most likely face more problems once the first issue is solved. Those observations led the CEO of Berkshire Hathaway to coin the following well-known quote: "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price."
Thank you for checking this video out, and don't forget to smash that like button and also subscribe for new videos every day. Turn that bell notification on and comment down below that you subscribed, and we'll make sure to reply and thank as many of you as we possibly can. Once again, thank you for watching, and see you next time.